when we talk about outbound investments, I'd like to, first of all, the panelists to tell us why do we need to look at outbound when India is doing so well? So I'll start with.
Thanks, Prem, and thanks to you and IFSC for facilitating this forum. I think all of us who've been in this industry for 20, 25, 30 years, and all of us, including myself, for the longest time have been investors only in India, as you mentioned. And as Indian investors evolve, and need to invest, need to accumulate corpus, overseas for many end users that both Pradeep and others have been articulated in the last 1 hour. I think it's very important to start looking at global avenues as well. I think one, the aspect of asset allocation, I think that's very, very critical, to ensure that you hedge not only between asset classes, but even between geographies. And as we've seen, I think very compelling data is that, as Saurabh also mentioned, not only in the last 20 years, but if you look at last 10 years, in dollar terms, you've seen S&P 500 outperform Nifty 50 8 out of 10 years in dollar terms. And even gold, last couple of years we've been seeing gold the way it's rallied. 6 out of 10 years again, S&P 500 has been very, very it's outperformed gold 6 out of 10 years. So I think it's a very, very important aspect of discussion. I think all of us have been 95, 98% of our investments are in India. But as investors evolve, as world becomes more integrated, and you become more aware of opportunities, overseas, this amount is increasing. So out of the total LRS investments of 30 billion a year, which has doubled over the last, I would say, 7 to 8 years, 230 from 14 and a half to about 30 billion a year. Investments, that quantum has quadrupled from about close to $400 million, about 2019 to about 1.7. And as, Saurabh mentioned, $1 billion of that is out of gift. So I'm assuming the other bit is just about, 600 to $700 million. So that's well, in absolute terms, it still needs to sort of, go up, and it will. But I think in terms of just the pace of growth is very, very sharp. I think these are, and also some of the themes, which, we as Indian investors may not have access to. So within S&P 500, you will see some of the themes like, the S&P 500, communication index, has delivered a US return or, the dollar return about close to 14% over the last 10 years. Now that translates to ballpark 17 to 18% INR. So you will have many such themes. And I come from the AIF, world now. So if I just look at the private debt or private credit space in the US, where office space has just not done well, especially post-COVID. So there again, if you see that industry itself, that space itself has delivered about 14 to 16% in terms of, again, dollar returns. So that translates to, again, INR return of anywhere between 17 to 20%. So I think a lot of us have had that notion that developed markets, etc., may not have, alpha, may not have pockets of growth. But as, Saurabh showed, as some of these numbers enumerate, I think there are many opportunities, overseas. We have been focused in US, bank stocks, Max 7, etc., because obviously they have done well. But there are many, many other pockets of opportunity.
Okay. Now, Lovaii, why must wealth managers develop a global offering for their clients?
So I think the way I would look at it is from the client standpoint. So there are probably three aspects to consider. One, what are the goals? Two, what is the risk? And three, what is the return? So if you think about the goals, possibly it was true maybe 2.5 decades ago that the wealth that Indians had was limited, and therefore most of the money that they had was required for goals within India. Not too many people were sending their children abroad for studies. And then, all the consequent effects of that, of them continuing to stay on and work over there and therefore need money over there, and parents also need to travel there, etc. But I think as time has gone, as wealth has increased and number of people going abroad for studies has sort of increased, you're now starting to see that goals are happening across jurisdictions. And therefore, one of the aspects of making sure that you reduce your risk and improve your returns is to avoid the currency risk. So if you can make sure that you keep accumulating currency in the denomination that you need the money for, that's, I think, one important aspect. I think from a risk standpoint, we've always advocated that as financial planners, we tend to look at debt and equity as the asset class and start from there. In my mind, there are 3 levels above that. There is how much you invested in which country, how much in which currency, and then between physical, financial, and then in the financial, you will get down to debt, equity, etc. So I think we tend to miss out the country currency piece, possibly because maybe 15, 20 years ago, you had feeder funds only that you could invest through. So it was rupee, you didn't really have to do any currency conversion. ETFs then came on, and then so on and so forth, the products came. And I think the third aspect, as you mentioned, is returns. And I think the fact is that there will always be cycles in which one market will outperform another market. So at this point in time, I think everyone is very gung-ho looking at last 10-year returns and trying to show how well the US market has done. But there have been periods in the past of 10, 15 years at a stretch where the US market has given zero returns as well. So I think one has to be aware about the fact that different markets give different returns at different points in time. And therefore, diversification also becomes important. So while you're chasing return and hoping that by looking in the rear view mirror, exactly the same thing is going to happen going forward. And we all know that that doesn't necessarily happen. So I think it's a variety of these.
Okay. Sudhendra, what has made you look at global investments?
As Lovaii has told, the typical mindset which we had before versus today, we are globally exist. So from morning to evening, I think Saur was actually to explain that most of things what we do is global. So I recall my early career in HDFC Bank, 2005 days, there was no NRI channel at all. So they actually launched an NRI channel, typically called NRI RM and NRI. The wing was just a part of retail branch banking then. So I could able to see that the way they started segregating the NRI clients separately to start looking at them as separate entity altogether, and how can we serve them better compared to a normal retail banking. So I see in a wealth management industry today in the same situation. I think we should start looking at NRI as a separate business altogether, give them different requirements, and give them, help them to, figure out how better they can invest globally or, inbound and outbound both. One more thing which I observed, I think Saurav was able to, tell that we used to issue this, letter for visa for, going abroad. They ask for, that certificate. The number of letters we're issuing is multifolded in last 6-7 years. So which waken up, somewhere, money is going abroad, whether we like it or not, through LRS route, either they'll stand money. And second thing is that we did a homework about 8 months back. We started a NRI channel separately. So where 8-10 months back, we did a homework. We have more than almost $3 to $4 million of ESOPs of US companies. I think somewhere it is sitting somewhere, and it's not a part of our asset allocation. And we are giving a recommendation, in the, wealth management space without considering that money. Okay. I think it's high time for us to do the, outbound and inbound, both the sides. It is necessary now because it's become a, integral part of our wealth management. That's why I think it is necessary.
Okay. One very important, we talk about asset allocation. You started with that. So how much allocation should we look when we're doing geographical diversification. I know there are obviously limitations because of LRS on how much you can invest overseas. But let's say over a period of time, what should you aspire to have? What percentage of your allocation should be in non-Indian investments?
See, as an asset manager, I think clearly, and when you look at asset allocation, I think the end goal is very, very critical. As Saurabh mentioned, he has, education of his son, and then he has to plan for education of his daughter. Okay, so that becomes a very large theme. And now you have Indians, also acquiring real estate overseas, so there are people accumulating corpuses. I think eventually it will come down to what is the end goal and over what period it is spread. That is one. Number two, also now, since IFSCA has also now permitted, retail investments. So earlier it was restricted license, which has $150,000, dollars that you could invest. Okay, so now the ticket sizes potentially could come down much, much lower. So in fact, we have 3 asset managers who started with maybe $5,000, $1,000. So that is really up to the investment manager to decide that. So there is broader participation, which now enables even so-called retail, or mass affluent investors to allocate overseas. Okay, so that will become a very, very important aspect as people start to allocate. So from a percentage standpoint, I think, core allocation to my mind, will always be India because this continues to be the growth market and a market that promises, great returns and familiarity. What IFSCA does is with this jurisdiction now available, it is like, ye to ghar pe hi hai, so that breeds a sense of a lot of comfort. So core allocation to India, perhaps basis the overall corpus available, I would look at maybe 15 to 20%. I'm not a wealth manager like these two gentlemen, but I would say a small portion. But to my mind, as the base of investable surplus expands, in absolute terms, this number will continue to move up.
Lovaii, 15 to 20%, is it?
I don't have a number because I think it is not a generic number. It really varies based on each individual. You might find that somebody who has only or probably has 90% of investment in India, because over time as the next generation goes abroad and they also want to start making sure that they are transferring assets, you might suddenly start seeing the number going very high, but it depends on the quantum. So if there's enough available for the goals in India, then I think they're free to move their money wherever they wish to move the money. And then that's a call that you take between dollar rupee, between US and Venezuela and Thailand or wherever else you want to invest.
Okay.
I think similar thoughts. I think, it is very difficult to put a number as such, but definitely, it's going to be a substantial amount of the portfolio for sure. I believe 15-20% should be looked at because the currency changes and necessary to be given to reduce the standard deviation. I think it's necessary nowadays here.
Okay. Now I'll start with you, Lovaii, here. When you start looking at global investments, how do you research these markets? Because how do you research opportunities there? Because there is very little information to come by. If you're looking at Indian mutual funds, obviously they have, I think Bangalore itself would have at least branches of 40 AMCs, if not more. But when you're looking at overseas investments, how do you do research? Who tells you what products, what vehicles, what platforms?
Hey, I wish my research head was here to answer this question. But I think what has happened over the years is because we have had a large number of clients who have cross-border sort of investments, and we were looking for these, we start seeing even fund managers and product and platform providers coming and reaching to us, which allows us to research a lot more. Plus, we do our own reading, of course, to see what's going on. The other important piece of information actually comes from our clients, because the clients are being approached by different fund managers and different fund options, and they bring those to us and say, this is an option that we've got, and that allows us to sort of evaluate. I think if you look at the number of opportunities, both in terms of type of products, number of products, class of products. Aashwin mentioned there are different types of products that you've not even thought of over here, like life settlement funds as an example. They're not available here, but they are available overseas. And you start looking at how does that fit into client portfolios. Then you're sort of, I think, expanding your knowledge and probably a lot more from experience rather than from let's read a book, because then you'll have 100,000 of options. And it's always very difficult to choose which is the one or the top 3 or the top 5 things to do.
Okay. Yeah. So same question to you. How do you gather information about the opportunities overseas?
I think predominantly now we are getting information from the clients. Basically, they are coming back with the thought process that I have an ESOP, I am moving the money to a fund or a PMS kind of a structure there. Will it fit my portfolio or not? That was the basic information to start with. Later we start now, investing.com can give a lot of information to us to at least do some basic research. So we have put across certain processes in place now. If I don't have a hands-on information to tell you that we have, developed something which can give you a, process note as such. But of course, we get able to do some quality, work going on. I think maybe 6-8 months from now, I think thanks to, Gift City, we are getting a lot of information hands-on now. I think maybe 18 months from today, we'll be able to have a system which can give you 1, 2, 3, 4 parameters to at least to select a fund, select a scheme, or select a stock, whatever it could be. I think that is a way forward, I believe so.
Yeah. So, Prem, I think I would look at it from this standpoint of, there are many nuances involved, okay, regulatory and otherwise, when you look at cross-border transactions. So one, I think Saurabh, did highlight the correlation between markets. If I'm looking at, overseas markets, how is it related to, market India? Like you have, inverse relationship, direct relationship. So what is the correlation? One. Number two, I think taxation assumes very, very important aspect. Okay, so countries that India has DTAA with, which is Double Taxation Avoidance Agreement. Okay, and for example, if I was to, look at investing in an ETF overseas in the US, right? So what is the tax treatment? Because it can get really onerous if it's not understood well. Okay, so I think it's incumbent on us investment managers, wealth managers to also explore that aspect. So if you have feeder into an ETF, right? So if you have a double taxation avoidance agreement, okay, how is the income being treated? Whether it's capital gains, whether it is interest income. So for example, the underlying companies in an ETF in the US, when they declare dividend, okay, there is taxation which is at source, which is 15%. So when you bring back that income, okay, you don't pay anything on that because that's on US at source, right? One. Number two is when you get that money back, okay, after 2 years, it's 12.5%. But the difference could be between an LLP and a company, right? So their tax treatment would be different on capital gains, etc. So I think those are nuances that are very important when you are talking to your investors and advising them on overseas investments, because the structure of the vehicle, okay, becomes very, very critical.
Well, okay. Now, talking about the structure of the vehicles, how do we choose, Lovaii and Sudhendra, how do we choose what is appropriate, whether it is direct stocks, whether it's mutual funds, whether we go for actively managed mutual funds or we go for passive funds such as ETFs? How do we research that? Because all of them have certain tax implications. All of them have certain, cost implications. So how do you do all this research? And tell us a little more about what are the advantages or disadvantages of each of these.
So I think the way you need to think about building portfolio is like constructing a building. So first the foundation. So you don't want to get into very exotic stuff at the start, especially for people who have not experienced anything else. So there's no point in, of course, there is a lot of push from a client who says, I want to invest in this innovation fund, because I know innovation is going to do very well, but I've had no exposure at all in any market internationally. we would tend to push them more towards ETFs and, structures where the costs are low, the risks are lower, the risks of going wrong are lower. And that's something that we would like to explain to them. And only after they've sort of got the foundation in place, then I start building first story, second story, and 25th story if I need to. I think it would be wrong to try and push them on the other end. But, ultimately the client has his money, has his influencers, and sometimes would say, no, I want to get into that. And sometimes the consequences are not all that great. So I think it's a bunch of understanding what the structures are, what are cost structures and potential return structures, and then go forward into a little more exotic products.
Okay. So typically, Sudhendra, what are the kind of products and structures that you recommend?
See, I think basically we start recommending with the ETF structures only because that's a simplest way to, make them to come in. Okay. See, beyond tax, we should start looking at teaching them the behavioral thoughts. You are not entering to global markets because of fear of missing out. Or some influencer is talking about it and you just want to jump in. Somebody told Nasdaq has given an 300% return, we just jump in 10% of the portfolio. That should not happen. So we have to handle them in such a way that of course we required an allocation to global. The answer is yes. That what percentage, how slowly you should take the things forward and then scale it up. I think we recommend foundation simple products, maybe looking at ETFs or maybe index kind of instrument, and later we can look at complex structures, which also gives us leeway to understand better and give them recommendation.
Can I just add, I think the other important thing is for Indians investing in US products and US held stock, there is inheritance tax, which people don't seem to be aware of and ignore that factor. And I think that's an important aspect also to take care. So if the amounts are large, there are ways to invest even in Nasdaq, but does not the US tax will not apply. There are UCITS that are available, and those are things that we would really look at and recommend to clients as well.
Okay, Aashwin, I wanted to ask you something. There are public markets and there are private markets. Okay, the private equity, private debt. And so is there any merit in looking at private markets also, because they may offer the more lucrative deep tech AI kind of opportunities which we in India are not so.
So Prem, so both Lovaii, Sudhendra have emphasized, the Indian investors, may not be exposed to too many exotic products overseas, and I think to a large extent they're right. But when you look at, talk to a lot of, HNIs, families, for example, okay, so they already, and even, maybe salaried individuals who are CXOs, etc., in the respective organizations. So they would talk about how they, bought NVIDIA, 3 years back and 4 years ago, and they obviously are very happy about this because they think they got that call right. Okay, so a lot of these investors at a certain, strata are already exposed to some of these. But yes, like you have, sorry, I'll just take a minute on this. So like you have overseas investors, when they come into India, they typically invest in a Nifty 50 ETF. That's the most liquid, most well-known, most transparent. And then they would possibly, graduate to other asset classes, other stocks. Similarly, I think here, to your question, from a discerning investor who already is exposed to perhaps, the basic, markets, in the US or elsewhere, I think it makes imminent sense because, again, to my earlier point, markets such as Europe and US offer a low correlation to what happens in India, especially in the private markets. So if you have real estate, for example, in India, office space in India, for example, and Bangalore is the largest holder of office real estate in India. Okay, that's done very well over the last 4 years, especially after COVID. While in the US and all other markets, it's completely in disarray. So it's given all those negative returns post-COVID in these markets. So yes, if the risks are explained, okay, they already have exposure to some of those markets over the last 10 years because there are many. And so there'll be a particular strata particular segment of investors who, even though we may not recommend right now, but they already perhaps are in those markets.
Just I'm curious to know, Aashwin, is Nippon, does it have any products currently which under the alt structure which offer access to overseas its opportunities?
So Prem, before alt, I was in the mutual fund stream. So yes, in fact, I started my cross-border investing journey with the mutual fund part, which was, feeding into Morningstar US fund, Taiwan fund, which was heavy on semiconductors theme. Okay, although that didn't do too well because then there was this geopolitical issue between China and Taiwan, recovered thereafter. So yes, through the mutual fund, we've had about 4 feeders, including the Hang Seng, that we've had for long. And that obviously is not operational right now because since February of 22, the RBI limits kicked in. On the GIFT City, we are just launching our first fund, outbound fund retail in January.
Okay. And what is the investment objective of that?
Investment objective is AI, big data. Okay, it's a fund which is about 10 years old, so it has a sizable track record, but looks at a wider spectrum of AI and big data with adjacencies built in.
Okay.
It's a fairly long and not only US, but also looks at other markets.
Okay.
But for retail investors as well.
Okay. And how will you research these markets? Because these are fairly...
So it's an ETF.
It's an ETF.
It's an ETF which is there. So it is, as I said, the fund is existent. So we're just feeding into that fund.
Okay, great. Now coming to you, Lovaii and Sudhendra, when you sit down with your clients and so you said you look at what their needs, risks and all that is. So do you have preferences, other things being equal, do you have preferences as far as geographies are concerned? Do you think Japan or China or America or these things? So while some of it would be driven by the fact that they have a currency requirement, which is son is going to study in Spain and hence you would probably like something in euros. But other than that, if there were someone who did not have any such requirements, what would be the geographies that you would kind of recommend?
Yeah, so our view has been that the US market is expensive and we would actually like global investing to be ex-US. Europe is something that we have been looking at, and for last maybe a year and a half or so, China and emerging market is actually more favored than developing market. So these are some preferences, but then we get into specific products and specific opportunities that exist and then suggest to them. To your earlier question to Aashwin, I will also say that as wealth managers, while we are sort of going down the route of saying let's go into investments in a slow, staggered manner, I think it depends on who your client is. So if your client is the more evolved client, then definitely you need to have the private equity and such like options available, and we do have them. So we do have the option to make higher return but higher risk and maybe longer lock-in periods, because that's another important piece, that your cash flow will not be there for a few years. If you're willing to do that, then opportunities do exist. So I think it's a variety of that. And what I mentioned about countries is probably more a tactical, that this is what we would do today, but it doesn't mean that it is zero US. You cannot have investment globally with zero exposure to US. I don't think that's the right sort of strategy. You can decide how much you want to overweight it or underweight it. But that's our thought at the moment.
Okay. So far, given that you've had some experience in, have you seen any geographical bias towards certain geographies?
Specifically, no, but US will play an important role for us because the client size, the clients we handle typically being clients. So the NR division always comes back with, predominantly we're focusing on that ESOP and, the data which we have. There's huge amount of money, which is either allocate to single company, or it may be couple of companies, or maybe as Sir was mentioning that somebody jumped in and bought a Nvidia and he is really rich today. And we also have some experiences like Tesla has been bought and it's down. They're crying now, and Amazon at some downtime. So I think we are figuring out a way that how can we use this already existing asset allocation, which is already there as a huge. But if you ask me, somebody has 10 rupees here and he has 95 rupees somewhere else, 90 rupees somewhere else. So can we do asset allocation right way there? No, we move there. I think we're figuring out a way what existing assets we have. Can we streamline that first? Then looking at how we can look at different world altogether. That's a thought process we have. Right.
Yeah, sure.
Prem, see, I think US, just not India, which we've been talking about US for a while. I think it just is such a massive pool of opportunity in terms of deployment, in terms of wealth available there. So in India, okay, out of in total $100 that come into India, 77 come from the US. Okay. So that's not only the FPI, that would be slightly lower, but when you look at even real assets, okay, money coming into infrastructure funds, money coming into roads, etc., some of those, in form of FDI. Okay. So that is of even larger pool. Okay, so when you look at Japanese investors investing outside, okay, the only single country exposure that Japanese investors or some of the other jurisdictions take is to the US. They would also not want to take, when it's a single country exposure, they would either want to invest in an index which offers multi-country exposure, or they would want to invest, if one country that they would want to invest is US. I mean, I know, with Trump coming in and, it's saying the US is overvalued, AI could be a bubble and all of that. But still, the comfort, okay, that, the globally that people have with US as a jurisdiction is massive. And that is where I think those opportunities. So one is ETFs, where, you say, okay, there is a risk involved. Okay, but there are such micro themes available in public markets. Okay, so that I think is very, very important to research well, educate ourselves as either investment managers or wealth guys, and then guide investors. Because today I see investors themselves have become very, very aware. They talk to their friends overseas, they get literature, they access information. And you rightly said, a lot of the information that we get is through our investors. And then we sort of start researching, this is what he said, let me see, is there something else that I can add? So that's very, very important.
Okay. Now, starting with you, Sudhendra, tell us about some of the complexities and the hurdles which people face when they are investing overseas.
I think the first hurdle is the onboarding. Currently, if you ask me, if City or any other model was definitely a hurdle. But I think we should look at mutual fund KYC process in 2005. To start accepting a certain expectation with the client. That actually adds a lot of struggle when you go and approach something and pitched it, and it takes quite some time to get onboarded to open a zero folio and then start outgoing or inbound, both the cases. That's the first challenge. Second challenge is that I think getting money which they intend to invest versus by the time they invest, it'll be much different. For example, we'd have a discussion for couple of crores. By the time the onboarding process happens, by then they would have also explored, because we have given an idea that you can diversify your investments abroad somewhere. So they'll come back, they already have an account in some other broker which is in US. So why can't I do that there? And things will come up. I think those two challenges I think we are facing currently. But I think it'll sort out. I think as Sir was mentioning that it'll be smoothened. I think maybe a couple of quarters from here, I think it'll be much better. That's what we. Okay.
So I'm curious to know what are the opportunities beyond the gift city in that case? I mean, if you were to use platforms, interactive, vested, do you circumvent some of these things, or how did it work? How's the onboarding?
I've not explored it as of now, but I've heard from the clients. Again, we have learned from the clients that they have vested account, they have invested now partially and things like that. But we have not explored as a distributor or a partner as such. But we are only explored as of now GIFT City.
Okay. Yeah. So I wanted to talk about some of the procedural constraints which could come up.
Yeah, so I think I want to go a little beyond procedural, because I think the biggest complexity is knowledge. Because as soon as you have clients in different jurisdictions or investments in different jurisdictions, both of these need to be treated carefully. There are issues on reporting, there are issues on taxation, there are issues on whether there is going to be tax deducted at source, or there's withholding or not, and how do you do it. There's inheritance tax, there's currency issues, so there's a whole bunch of things. And then to top it all, you will have families with members in different jurisdictions, either one generation up or one generation down. Both are probably holding the same citizenship or different citizenship. And you starting to unravel complexities which you cannot solve by yourself unless you collaborate and have enough knowledge through maybe CPAs who understand multi-jurisdiction, or with lawyers who understand multi-jurisdiction, or with investment advisors as well in other jurisdictions, because you will not know all. The same way as you will not expect an advisor from US or UK or Dubai to know what India is inside out on investment. We cannot know. We can think we have read and we know everything. We do not know. And I think every single day we come across a client situation where there is some new learning. And then we have to go back and talk to these professionals that we work with and then find out the solution there. Because what we see is that the complexity increases because the younger generation is a lot more mobile. So they will move to a third jurisdiction. So they will leave traces. I'm invested in country A, I moved to country B, now I invested, then I have moved to C. Now I have to deal with the issues that arise with the investments in A and B. I think those are the bigger ones. We do deal with interactive brokers. We deal with multiple others, Crystal and other platforms as well. So we understand some of the nuances. The first time around, it was very complicated because we didn't understand all the steps. So we had to keep going back and forth. But now I think it's sort of smoothened out. But there's always some new form, a new procedure that will come up and you have to deal with it. Really nothing that we can do at this point.
Okay. Now,
To this, I think my plea to Pradeepji has been for a while. Okay, one is the TCS part. I think that is something that renders it slightly inefficient because it delays, that 20% of your investable surplus, goes to the taxman. You can claim it later, but it's a while. Plus, the interest on refund is calculated start of the financial year and not from the time your TCS was deducted. That is one. Number two also is, I think the taxation part broadly, okay, from jurisdiction to jurisdiction still is not absolutely clear. I mean, if you were to approach even the tax firms in India, we've had instances where two partners from the same tax firm advising on the same jurisdiction had two different opinions. Okay, so who do you believe? So it is complicated, but I think if now has, taken that initiative, so where I would request, some of, it comes in the realms of clarity. Number two. Number three is, I think overseas investment, be it listed, otherwise is still considered unlisted. So I think there are a lot of times, at least I've been questioned, because I'm investing in XYZ in a ETF, it is still considered unlisted. So cap gains goes up to 2. I thought it's a broader discussion, wider discussion, but possibly will require the regulators to collaborate and, come out with some clarity. And I think onboarding now for at least outbound is very simple. So thanks to you. But guys, I think it is mutual fund, CVL, which is used. So I think that is not a problem, except for then the Form A2, etc. A lot of that needs, signing. But overall, I think from outbound standpoint, it's easier. Inbound from a KYC perspective, I think that is some video KYC, etc. I don't know if it's been dealt with, but
So one is on the KYC piece, I think good that you, in case of inbound, we have brought the video KYC on from 35 countries now. Video KYC, it was 2 weeks ago we have operationalized it. On outbound, we are operationalizing the first KRA in GIFT. So you will not be forced to do a full KYC process once again. So this is happening hopefully by February, that should take.
Fantastic. Sure.
It's very helpful. Thank you.
So on that very optimistic and good piece of news, we end this discussion. Thank you, Aashwin. Thank you, Lovaii. Thank you, Sudhendra, for a wonderful session. And I hope all of you benefited from it. Let's give a big round of applause to my panelists.